You're scrolling Zillow at 2 in the morning, and every house that doesn't look like a crime scene costs $500,000. The bathroom has the original tiles from 2003. There's carpet in the kitchen, actual carpet in the kitchen. And some real estate agent who drives a Lexus has the nerve to call it a charming starter home. Meanwhile, you're sitting there in the dark doing salary math in your head, wondering if you somehow missed a promotion or if the entire housing market just decided that normal people don't deserve walls and a roof anymore. Spoiler alert, it's not you. It's the math, and the math is absolutely savage. My name is Charles, and today we're going to do something that makes real estate agents physically uncomfortable. We're going to calculate who can actually afford a $500,000 house in 2026. Not who qualifies for the loan, not who the bank will happily drown in debt, but who can legitimately afford it without turning their entire existence into a financial anxiety simulator. Because there's a galaxy-sized difference between getting approved for a mortgage and actually being able to sleep at night after you sign those papers. Let's start with the part nobody wants to say out loud. In dozens of markets across America right now, $500,000 is considered normal. That's not buying you a mansion. That's not even buying you impressive. That's buying you 1,200 square feet, 3 bedrooms, 2 bathrooms, and a backyard roughly the size of a yoga mat. In cities like Denver, Austin, Seattle, or anywhere within an hour of a major metro, $500,000 is what regular people are somehow expected to afford for regular houses. The median household income in America is around $84,000. So we're asking people making $84,000 to buy homes that cost 6 times their annual salary. If that ratio sounds completely unhinged, congratulations. You're still capable of basic reasoning. But everyone keeps telling you it's possible. The mortgage broker says you're approved. Your parents bought a house on way less and won't stop reminding you. Some guy on TikTok is flipping houses with vibes and a credit card. So what's the problem? The problem is that everyone is lying to you about what affordable actually means. And look, if you're tired of financial advice that sounds like it was written by someone who inherited a trust fund, hit that subscribe button. This channel is about running the actual numbers on the stuff that's supposed to be normal, but somehow costs more than your parents' first house. No fluff, no get-rich-quick schemes. Just math that actually makes sense and permission to opt out of financial decisions that don't work for you. Let's start with the down payment, because this is where most people's dreams go to die, a quiet mathematical death. The old standard was 20% down. On a $500,000 house, that's $100,000 in cash. Let me say that again so it really sinks in. $100,000. The median savings account in America has about $8,000 in it. So you're not a little short. You are $92,000 short. And before you say you'll just save it, let's do that math too. If you're making $84,000 a year and somehow manage to save 10% of your gross income, which almost nobody actually does, you're saving $8,400 per year. At that rate, it will take you 12 years to save the down payment. 12 years, assuming housing prices freeze completely, which they absolutely will not. Okay, so you skip the 20%, you put down 5 or 10% like most people actually do. Congratulations, you just unlocked a brand new expense called PMI, Private Mortgage Insurance. This is the monthly fee you pay for the crime of not being wealthy enough to drop 20% in cash. It's essentially a poverty tax that runs anywhere from $200 to $400 every single month. You are paying extra money to protect the bank, not yourself, because they're worried you might default. So you're starting this journey already being financially punished. Now let's talk about the actual mortgage payment. You scrape together 10%, that's $50,000 you somehow manifested. That leaves you with a $450,000 loan. At current interest rates, somewhere between 6 and 7%, depending on your credit score, your monthly mortgage payment lands around $2,700 to $2,850. That's just principal and interest. That number doesn't include a single other thing you need to actually live in the house. Let's add property taxes. Depending on where you live, you're looking at anywhere from $4,000 to $8,000 per year. Let's be conservative and say $500 per month. Then there's homeowners insurance, which has gone completely insane in the past few years because climate change is making everything more expensive to insure. You're looking at another $250 to $350 per month, depending on whether your house sits in a flood zone, fire zone, or tornado alley. Then there's maintenance, the thing everyone forgets about until the water heater explodes at 11 p.m. on a Sunday. The general rule is 1% of your home's value annually for maintenance and repairs. On a $500,000 house, that's $5,000 a year, or about $417 per month. And don't forget the PMI we talked about. Tack on another $200 to $400. Let's add this up. Mortgage payment, $2,850. Property taxes, $500. Insurance, $300. Maintenance, $417. PMI, $300. Your total monthly housing cost is now sitting at roughly $4,367. And that's assuming nothing catastrophic breaks, you don't need a new roof, and your HOA doesn't randomly decide to repave the entire neighborhood and bill you $3,000. Here's where it gets really fun. Financial advisors say you shouldn't spend more than 28% of your gross monthly income on housing. Banks will approve you if your total debt-to-income ratio stays under 43%. Let's reverse engineer this nightmare. If you're spending $4,367 per month on housing, and that represents 28% of your income, you need to be making roughly $187,000 per year. If we use the bank's more lenient 43% rule, you still need to be pulling in around $150,000 annually. And here we arrive at the punchline. Only about 10 to 20% of households in America make $150,000 or more, which means 80% of American households cannot comfortably afford a $500,000 house under any reasonable financial standard. This isn't opinion, this is just math being cruel. But people are still buying these houses. So who are these people? Some have dual incomes in high-paying fields. Some have family money they don't talk about. And some are stretching themselves so catastrophically thin that one medical bill or job loss would collapse their entire financial existence like a house of cards in a wind tunnel. If this is making you realize you've been lied to about what affordable actually means, do me a favor and subscribe. Because every week we're breaking down the financial myths that keep regular people broke while the system pretends everything is fine. Next week, we're running the numbers on whether financing a car for 72 months is ever a good idea. Spoiler alert, it's not. And why everyone suddenly needs an $80,000 truck to commute to an office. Subscribe so you don't miss it, because apparently someone needs to say this stuff out loud. Let me show you what that actually looks like when you run the numbers on a real household trying to make this work. Meet the Andersons. Two working professionals with a combined income of $160,000 a year. That puts them well above the median, solidly upper middle class. They should be comfortable, right? Let's watch what happens when they buy that $500,000 house. Their gross income of $160,000 sounds impressive until taxes show up. After federal taxes, state taxes, FICA, and a modest 401k contribution, they're taking home about $9,500 per month. That's their actual money. Now subtract that $4,367 monthly housing costs, they're left with $5,133 for literally everything else in their lives. 2 car payments because they both commute, there goes $800. Car insurance for 2 vehicles, another $250. Gas, because nothing in suburbia is walkable, $300. Student loans, because they needed those degrees to get the jobs that qualified them for this mortgage, $600 conservatively. Health insurance premiums their employers don't fully cover, $400. Groceries for a family trying to eat reasonably healthy, $800 if they're careful. Utilities for that bigger house, electricity, water, gas, internet, phones, $450. We're now at $1,533 remaining. And we haven't touched clothing, entertainment, kids' activities, car repairs, medical copays, or the basic psychological need to occasionally leave your house and pretend you have a life. Oh, and savings, emergency fund, retirement beyond that modest 401k. Good luck. This household is spending 46% of their take-home pay on housing, not 28%, not even 35, nearly half. And these aren't irresponsible people buying jet skis and taking European vacations. They're just trying to live in a house the market calls normal. Here's what that actually feels like day to day. It feels like checking your bank account before buying groceries. It feels like saying no to your kid's field trip because that $35 might be needed when the check engine light comes on. It feels like lying awake at 2 a.m., doing mental math about whether you can afford new tires this month or if you need to push it to next month and pray it doesn't rain. It feels like being one unexpected expense away from disaster at all times. The HVAC breaks. That's $5,000 you don't have. Someone rear-ends you and your deductible is $1,000. Credit card? Your kid needs braces? You're financing dental work like it's a car? This is the reality for households earning $160,000 trying to own a $500,000 home. Now imagine what it looks like for households making $120,000 or $100,000, or God forbid, the actual median income of $84,000. At median income, buying a $500,000 house isn't tight. It's not stretching. It's financial fantasy. It's mathematically impossible without either massive external help or accepting a level of risk that would make a base jumper nervous. But here's what makes this truly insidious. The housing market doesn't care about these numbers. Sellers listed $500,000 because that's what comparable homes sold for. Banks approve buyers at 43% debt to income because technically the loan won't default immediately. Real estate agents encourage buyers to stretch because their commission depends on closing the deal. Nobody in the transaction has an incentive to tell you that you're about to financially drown yourself. The system is designed to get you into the house, not to ensure you can comfortably afford it long term. And once you're in, once you've signed those papers and moved your furniture, you're trapped. You can't just decide 6 months later this was a mistake and walk away without destroying your credit and losing your down payment. So people stay. They stay in homes they can't afford, working jobs they hate because they can't risk any income disruption, slowly watching their savings evaporate, wondering why they feel so stressed when they're supposedly living the American dream. Let me tell you what the harsh truth sounds like. For 70 to 80% of American households, a $500,000 home is not affordable, not sustainably, not without accepting a level of financial precariousness that would have been considered reckless a generation ago. This isn't about personal failure. This isn't about not working hard enough or lacking financial discipline. This is about a housing market that has completely disconnected from income reality. Home prices have increased roughly 400% since 1990. Median household income up about 180% in the same period. The math doesn't work. It cannot work. It will not work. And yet we keep pretending it does. We keep telling people that homeownership is essential for building wealth, which is technically true, but ignores the part where you have to survive the mortgage first. We keep perpetuating the myth that if you just budget better, skip the avocado toast, work a side hustle, you can make it happen. But you can't budget your way out of a structural affordability crisis. You can't side hustle your way into a down payment when rent is eating 40% of your income. You can't manifest a lower interest rate through positive thinking. What you can do is understand the actual numbers so you can make an informed decision. Maybe that decision is to keep renting and invest the difference. Maybe it's to look at a $350,000 house instead, even if it means a longer commute or smaller yard. Maybe it's to acknowledge that home ownership in your current market simply isn't viable right now. And that's okay. Because here's what nobody tells you. There is no prize for buying a house you can't afford. There is no trophy for being house poor. The stress of barely making your mortgage every month will erase any pride you felt the day you got the keys. The real question isn't whether you can technically get approved for a $500,000 house. The real question is whether owning that house will actually improve your life or just transfer your money to a bank while you stress about property taxes. And for most people, when you run the honest numbers, the answer becomes uncomfortably clear. So, what does this mean for you practically? Let's be direct. If you're looking at a $500,000 house right now and your household income is anywhere south of $140,000, you need to stop. Just stop. You're about to make a financial decision that will dominate and potentially ruin the next decade of your life. I don't care what the mortgage broker says you're approved for. I don't care what your real estate agent says is normal in your market. I don't care that your friends somehow made it work. The numbers are the numbers, and they don't care about your feelings or your Instagram-ready kitchen dreams. Let's talk about what happens when you ignore this advice, because plenty of people do. You stretch, you convince yourself it'll be fine. Maybe you're betting on a future raise that hasn't materialized yet. Maybe you're planning to pick up freelance work on weekends. Maybe you're just really tired of renting and you want this so badly you've stopped thinking rationally. So you buy the house. Congratulations. Now what? Month one, you make the payment. It's tight, but you did it. Month two, same thing. You're cutting back on eating out, skipping the gym membership, but managing. Then month four, your car needs new brakes. That's $800 you didn't budget for because every dollar is already allocated. Credit card. Month seven, the air conditioning dies in July. Repair quote is $3,500. You don't have it. You finance it. Month nine, your spouse's hours get cut at work. Suddenly, you're $600 short every month. And that emergency fund you were supposed to build, it never happened because there was nothing left to save. This is the reality of being house poor. You own a house, technically, though the bank really owns it for the next 30 years, but you can't afford to live in it comfortably. You can't afford to maintain it properly. You definitely can't afford to enjoy it. Every unexpected expense becomes a crisis. Every financial decision is filtered through, can we still make the mortgage? You become a prisoner in your own home, working to pay for walls you're too stressed to appreciate. And here's the really twisted part. Because housing has become so unaffordable, we've normalized this misery. We've rebranded financial desperation as adulting. Oh, you're house poor? Welcome to homeownership. Can't afford furniture for 3 rooms? That's just part of the journey. Eating ramen because all your money went to the mortgage? You're building equity. It's like we've collectively agreed to pretend that struggling to afford basic home ownership is a rite of passage rather than a symptom of a broken system. The math is screaming at you, but culture keeps whispering that you should buy anyway. Your parents bought a house at your age. Never mind, their house cost 3 times their annual income and yours cost 6. Your friends are buying. Never mind, you have no idea what their actual financial situation looks like or whether they're drowning behind their freshly painted front door. Society tells you renting is throwing money away. Never mind that being unable to afford your mortgage is also throwing money away, just with extra steps and worse consequences. So let me give you permission to do something radical. You can choose not to play this game. You can look at a $500,000 house, run the real numbers, and decide it's not worth sacrificing your financial stability, your mental health, and your ability to build actual wealth. You can keep renting. You can save aggressively and wait for a market correction. You can look at cheaper markets or smaller homes. You can acknowledge that the American dream of homeownership has been warped into something unrecognizable and possibly unattainable. And that's not your fault. Because here's what actually builds wealth. It's not owning a house you can barely afford. It's having margin in your budget. It's being able to invest consistently. It's not having to choose between fixing your roof and contributing to retirement. It's sleeping at night without anxiety about next month's payment. Real wealth is freedom, not equity you can't access because you're trapped by the asset that's supposed to be making you wealthy. The financial industry has done an incredible job convincing people that homeownership is always the right move, that buying is always better than renting. that you should stretch as far as possible because homes always appreciate. But they're selling you a product. They profit when you buy, not when you make smart decisions. The bank makes money on your 30-year mortgage. The real estate agent makes money on the sale price. The insurance company makes money on your policy. Nobody in that equation makes money when you say, no thanks, this doesn't work for me. So if you're sitting there right now feeling priced out, feeling like homeownership is slipping away, feeling like you're failing at some fundamental adult milestone, I need you to understand something. You're not failing. The system is failing you. Home prices have outpaced wage growth so dramatically that what was normal and achievable for previous generations is now a luxury item for most people. A $500,000 house is not a starter home. It's not affordable on median income. It's not something you should stretch for unless you genuinely have the income to support it without financial acrobatics. Run your real numbers. Factor in all the costs. Be honest about your income stability. And if the math doesn't work, walk away. There is no shame in saying this doesn't make sense for me right now. There is no trophy for buying a house that makes you miserable. The real win is making decisions based on reality rather than social pressure, on math rather than emotion, on your actual financial situation rather than what you wish it could be. That's how you avoid becoming another cautionary tale about the true cost of that $500,000 home. Look, I'm not telling you to give up on homeownership forever. I'm telling you to give up on the delusion that a $500,000 house is somehow within reach just because a bank will let you sign the papers. Those are two catastrophically different things. The bank's risk tolerance and your ability to actually live a life are not the same calculation. Maybe in 5 years, your income doubles. Maybe the market corrects and that same house costs $380,000. Maybe you relocate to a market where $500,000 actually buys you something reasonable instead of a glorified apartment with a mortgage. But right now, today, with current prices and current incomes, this math is broken for most people. And pretending otherwise doesn't make you optimistic. It makes you a future statistic in someone else's video about the foreclosure crisis. So here's my actual advice. Stop looking at what you qualify for and start looking at what you can genuinely afford without turning your life into a financial tightrope act. Find the number where you can pay the mortgage, handle maintenance, save for emergencies, invest for retirement, and still occasionally remember what it feels like to not be stressed about money. For most people, that number is nowhere near 500,000. And that's completely fine. You're not less successful because you're being realistic. You're not failing at adulthood because you refuse to financially drown yourself for granite countertops. You're just doing math that apparently nobody else wants to do. The housing market will keep pretending these prices make sense. Banks will keep approving loans that shouldn't exist. Real estate agents will keep telling you it's a great time to buy. But you don't have to participate in collective financial insanity just because everyone else is. Sometimes the smartest move is recognizing when the game is rigged and choosing not to play. If this video just saved you from the worst financial decision of your life, hit subscribe. Seriously. This channel exists because someone needs to tell you the truth about money that the financial industry doesn't want you to hear. We've got videos coming on student loan strategies that actually work, why your employer's retirement plan might be garbage, and how to know if you're actually ready to buy a house or just desperate to stop renting. Subscribe. Turn on notifications, and let's keep doing math together while everyone else pretends budgeting harder will somehow fix a broken system. I'm Charles, and I'll see you in the next one.